All right, welcome to The Explainer. Today we are going to tackle the secret language of financial charts. If you've ever felt completely lost just looking at all that market data, then this one's for you. We are going to break down some key lingo right from our source material to help you see the market in a totally new light.
Okay, so let's dive right into the big question. The one that, let's be honest, everyone asks when they first start. You stare at a price chart, you see all these lines zipping up and down, and it just looks like pure random chaos. But what if it's not? What if those squiggles are actually a language, with clues being written right there in real time?
And this right here, this is the core idea from our source material. The goal isn't to just sit back and passively watch prices move around. No, it's to actively train your perception, to develop an eye for specific, recurring patterns that show up again and again and again. It's really about making that shift from being a spectator to becoming an investigator. So here's our game plan. First, we'll start with that big idea of finding order in the chaos. Then we'll really define what these algorithmic signatures are. After that, we'll get into two key examples, SMT and ACB, and we'll wrap it all up by showing you how you can start training your own eye to spot them.
Okay, let's get right to it. First things first, we need a clear definition. When the source talks about algorithmic signatures, what in the world does that actually mean, especially for someone who's just starting out? So the easiest way to think about these signatures is like this. They're basically the footprints left behind by those massive automated trading programs that really drive a ton of the market's movement. The key here is that they aren't random, they are recurring patterns, and the whole goal, according to our source, is to learn how to spot these footprints in the sand. And here's why that's so important. This isn't about just memorizing old charts. It's about building a kind of mental library. By studying hundreds of these past examples, you're literally training your brain to spot these signatures almost instantly when they start to form in a live market.
All right, now let's look at our first really specific example of one of these algorithmic signatures. This is a classic pattern, one that new students often learn pretty early on, and it's known as SMT.
SMT actually stands for Smart Money Technique, and that's a nod to the big institutional players in the market. Now, what's so fascinating here is this idea of non-confirmation. See, usually two assets that are closely related, think about two major stock indices, they tend to move together. SMT is that moment when they don't. It's like a crack in the consensus, a subtle hint that the trend might be running out of gas.
So here is a perfect example. Imagine you're looking at two major US stock indices. On the left, let's say the NASDAQ pushes up and makes a brand new high. Okay, logically, you'd probably expect the S&P 500 over there on the right to do the same thing, right? But it doesn't. It actually makes a lower high. That disagreement, that is the SMT. It's a signal that the rally might be weak, and it creates a setup for a potential reversal.
All right, let's move on to our next key term, the ACB. Now, this points to an area on the chart where there's been some really obvious one-sided buying or selling, basically an imbalance. And it's another critical piece of this market language.
And this illustrates the concept so well. Just picture a huge, aggressive price move that leaves behind one of those really long candles on your chart. Well, that area of imbalance, it doesn't just go away. It becomes a reference point, almost like a magnetic zone on the chart, that price is pretty likely to come back to, or at least react to, sometime in the future.
This slide really shows you its practical side. It's not just some interesting observation, it's a real tool for analysis. The source explains that if the market is in a downtrend, what it calls a sell program, and the price climbs back up to one of these ACB zones, but then fails to break through it, that failure acts as a confirmation. The resistance is holding, and that reinforces the analyst's expectation for lower prices to come. So the source describes this exact sequence playing out. It's like a play in 3 acts. Act 1, a powerful downward move creates a big ACB. Act 2, sometime later, the market rallies back up, retracing right into that zone of imbalance. And then Act 3, price hits that area, reacts to it like a wall of resistance, and then powerfully expands away, continuing that initial move to the downside. It's a complete, recognizable sequence. So now that we've defined these individual ideas, SMT and ACB, let's just quickly recap how they actually work together, because they aren't just isolated tricks. They're pieces of a much bigger, more coherent process of analysis. This simple framework is absolutely key. You start with the big picture, right? The high time frame direction. Like the source asks, are you in a sell program or a buy program? Once you have that context, then you start looking for these specific signatures, an SMT divergence, a key ACB level, that actually align with that bigger story. This way, you're not just randomly spotting patterns, you're looking for specific evidence that confirms the market's underlying flow.
And look, this is the real transformation. This is the whole point. Learning this language moves you from being just a passive spectator to an active investigator. You stop just watching the chaos and you start looking for clues, forming a thesis, and actually anticipating what could happen next.
So, we've just given you the first few words of a brand new language. The real question now is, when you go back and look at the charts, what patterns are you going to see? Will you start to find the code that might be hidden in all that chaos?